In 2019, the yield curve in the US inverted for the first time since before the financial crisis. What does this mean? Should we care? And what does that mean for the next 1 or 2 years? In 2018, the US yield curve flattened, and in 2019, it actually inverted for the first time since the financial crisis. Now, why do we care about this? I suppose the first reason is that the US economy is one of the biggest in the world, if not the biggest. And certainly the US dollar is important to all other nations for things such as commodity trading and bond markets and so on. It's a key currency. Even if you're not fully invested in it, somehow it relates to your economy. So when the US sneezes, everyone catches a cold, basically, is the way to think about it. Now, normally, a yield curve is rising, and this is in a growing economy. And the reason that it's rising is the future interest rates have to take into account inflation because the economy is growing and people are demanding higher wages and they're buying things. Now, in a declining or contracting economy, you'll see this kind of a yield curve where the future rates are actually lower than the current rates. That means that something is about to change and not for the better. And basically, if we look at the 10-year US Treasury yield, and here's a chart of it, you can see that we were up until the end of 2018, we were around 3%. And now we're just around 2%. So that is a massive change. And again, that is signaling a downturn in the US economy, which is likely to affect everyone's economies at some point. It's just a question of time. So going into this year, going into 2019, we saw the general consensus being that there was going to be some additional rate hikes this year, like as in 2 or 3 possibly. And instead, in the short period of time since the beginning of the year, so that's basically 4 or 5 months, we're now looking at 3 rate cuts being priced in to the yield curve. Now, this is all seems quite academic, but what does this mean for the world? Well, if we look at the other economies in the world, you look at Germany, the UK, Japan, they're all kind of following the trend down. And that's because the US is an important trading partner. So if they're not able to take in, let's say, the goods that they're exporting to the US, because the US isn't doing as well, there's going to be a problem in their countries as well. And so that's what you're seeing reflected globally now. There's a downturn in the rates. In Germany, for example, their rates have actually gone negative for the first time in several years, since the financial crisis, in fact. What should we do? Good question. It's time to panic, or can we sort of think our way through this? And the right answer is not to panic. It's to sort of realize that something has changed and that you're going to have to change your portfolios, your investments, and you're going to need to make some plans as to how to deal with lower rates. And there's things that investors can do in this respect. So don't panic, think it through. Basically, there's 3 things that you can do this year. And there's no right or wrong time. No one can really predict when certain things will happen. In fact, a downturn an inversion of the yield curve quite often takes about 2 years to play out as a recession. So it's an initial sign, it's a harbinger of things to come, but it doesn't mean that you're going to have a recession immediately. Things can continue on to grow for a while. So what you can do, you can use this time wisely. You can switch to investments that benefit from lower interest rates. For example, high dividend stocks, preferred shares, utilities. These are all high dividend types of investments that are equities, but they tend to do much better than the average equities in a lower interest rate environment. Secondly, you can increase the duration or the maturity of your bond portfolio. So for the last year, generally what worked was having very short dated bonds, so bonds that were going to mature in the near future. Now that those interest rate rises seem to have sort of passed for now, and now that everyone is anticipating rate cuts, it's much better to have a longer term bond portfolio, so bonds that may mature in 5 or 7 years. In fact, if you bought US Treasuries, let's say 10-year Treasuries, you probably would have made about 5% already just on the movement, the sensitivity of the bonds reacting to the downturn in the interest rate curve. Finally, in these times where the interest rate curve switches from a positive to a negative or an inverted curve, you can expect volatility. And the reason for this is pretty obvious. People don't really know what the future is going to bring or when, a downturn will actually happen. And so they will overreact in one direction and then overreact again in the other direction. And as a result, you'll have volatility. And this volatility is your opportunity. Don't let it paralyze you, but let it be the opportunity for you to actually execute your plan and to move to those other types of investments that I just discussed. I hope you found this useful, and my advice to you is the last thing that you want to do is stay put with the kinds of investments you have, because what worked last year is not going to work in the next 1 to 2 years.